Hi, welcome to another episode of Financial Wisdom for Dentists. I'm Roger Balser of Balser Wealth Management, where we help you make smart financial decisions. Today, we're diving into a pivotal change that's reshaping retirement plans, 401ks, and the entire landscape of investment and saving strategies for dentists. If you haven't downloaded your 2023 year-end checklist, go to www.balserwealth.com/year-end. So let's start at the beginning. What is the Secure Act, you may wonder? Well, the government, they love their acronyms, especially in the military. And there's one, this one's basically a real goodie. It stands for Setting Every Community Up for Retirement Enhancement Act, or SECURE. It was originally signed by President Trump in 2019. Its purpose was to bolster the retirement prospects of American workers by facilitating the setup and accessibility of retirement plans for employers. Now, anything the government does, you have to say, did it really bolster the retirement prospects as intended? Well, it's a bit early to say yes or no. The 2.0 version was signed in 2022, and various elements are still being rolled out. You know how it goes. Legislation, some parts get delayed, some get pushed back, some get litigated. That's the way we world. I don't know. But the idea behind it, I think, was good. It was to help Americans prepare better for retirement. And here's why that's very, very crucial in today's day and age. Let's talk numbers for a minute. When we look at the average retirement savings balances by age groups, we're looking at some very, very, very concerning figures. For instance, those under the age of 35, they have an average savings balance of just over $30,000. And it doesn't skyrocket from there. Even the age group 65 to 74, they only hover around $426,000. Now, the discrepancy between average and median numbers, it's quite telling. For instance, while the average for the 55 to 64 age group is over $400,000, the median sits at $134,000. This disparity shows how the bigger numbers, all at the top of the scale, they can really skew the averages. The crux of the issue is that a substantial number of Americans, they just aren't saving enough. They aren't saving enough in their bank accounts or savings accounts, and especially for retirement. Shockingly, studies indicate that 60% of Americans, they don't even have a retirement-specific account. This stark reality highlights the urgent need for addressing retirement planning in this country. Now, retirement, as we understand it today, it's a relatively new modern concept. If we rewind back to the 1950s, the life expectancy for men was only 66, and for women, 72 back then. Retirement at 65, it aligned with life expectancy. People didn't anticipate long retirement years. Fast forward to today, and life expectancy, it shifted significantly. Men now live up to 74, and women up to 79 and more. However, our retirement age, it hasn't evolved in sync. The cultural mindset around retirement, paired with increased life expectancy, well, this poses a great challenge. Our work and career perceptions are also changing very, very, very rapidly. The traditional notion of working a single job for 40, 50 years and then riding off into the sunset, not happening today. Younger generations are redefining what work and career means to them. Moreover, the shift in expectations regarding living standards plays a crucial role. Our grandparents, they might have been content with a simpler lifestyle, smaller homes, while today's expectations for a fulfilling life, they often include grand experiences and higher living standards. All these shifts paint a picture of a changing retirement landscape. One where we're living longer, but retiring around the same age, or even a little earlier. The pressure to save for retirement becomes even more crucial today than it's ever been in the years before. Let me dive into some of the specifics of this Secure Act 2.0. One significant change affects the required minimum distribution, RMD as they call it in our business, for age, which it's been raised from 72 to 73. Additionally, now there's an allowance for Roth contributions in plans like the SEP, which is a simplified employee pension plan, and simple plans. For dentists with solo 401ks, the ability to contribute more and potentially shift to a Roth, it opens up intriguing possibilities that just make me excited to think about what we can do in the future. In catch-up contributions for those over 50, they've also been increased, allowing for additional contributions beyond the usual limits. Moreover, there are now enhanced tax credits for setting up retirement plans, making it more financially feasible for employers. These changes are part of a larger initiative to encourage businesses to offer retirement plans as they're getting a tax deduction and they're becoming more than just incentives. They're gradually transitioning, and they're transitioning into requirements. Next, let's talk about the tax strategies for dentists. Listen up. Maxing out your retirement plans, that can be a game changer. Once again, a game changer in tax planning. Check with your CPA though before you do it. Consider this: contributions made to a pre-tax retirement plan, they can yield significant tax savings, especially in our high income brackets, which many of you may be today. Imagine a scenario where you're contributing $30,000 to your 401k at a 35% marginal rate. That's a tax savings of about $21,000. But here's the kicker. When you retire, the chances of maintaining that same income level, well, they're probably not the same. They're very, very slim. So converting pre-tax contributions to Roth accounts in retirement, that could mean significant tax arbitrage, as we call it, shifting from higher to lower tax brackets. And for those concerned, if you're concerned about maintaining your high income in retirement, remember that lifestyle spending doesn't equate to tax brackets. Even if your current lifestyle matches your income, the reality in retirement is it often involves lower annual withdrawals and potentially substantial after-tax assets at that time. In the end, kind of recap here, planning for retirement and maximizing your pre-tax contributions now can pave the way for tax-efficient conversions in retirement. It's a strategy that's all about setting yourself up for financial success down the line. So many people need to do this. I hope you found this information valuable. If you'd like a more detailed look at the year-end strategies, go to www.balserwealth.com and search for year-end. Until next time, this is Roger Balser signing off. Stay financially wise. Do you have questions or financial matters on your mind? No worries. Simply chat with one of our advisors. It's easy, I promise. Whether it's a financial hiccup, a nagging question, or some past money mishaps or mistakes, we've got you covered. There's no judgment here. We've seen it all, and we're here to help. Just visit balserwealth.com and click on the book free consultation link, and let's set up a chat. It can be a quick 10 to 15 minute question and answer for guidance, or a deeper conversation if you're thinking about getting a financial advisor on board. Even if you just got a speedy, no strings attached question, fire it away to us at our email, Roger Balser Wealth. We're here to help no matter what financial journey you're on.